Good evening, everybody. Welcome to this evening's Inner Circle session. Welcome one and all to this educational session primarily. I hope you're good. I hope you're well. It's 40 degrees in Perth with a power outage. Still, it's been here for most of the day. So I hope you're keeping slightly cooler than I am. We're running this thanks to the wonders of modern technology and generators and the like. So please bear with me if there's any blips. We'll do our best to resolve them as we go. Thank you very much, Sonia. Right. Okay, let's get into it. And we're sort of talking about developing a trading edge, what it is, how to get one, all that sort of stuff. There's a presentation I did about a year ago, and I've sort of updated a little bit just to sort of offer some words of wisdom that come from yeah, just mind you to breathe. They'll come from sort of recent developments in some of the work we've been doing. But we've got to start, of course. We're going to look at some live markets, look, quick scoot around and see what's happening. So please remember to do your own due diligence on anything you see here. Make sure you follow trading plans and make sure you manage risk on every trading action. And thanks very much for popping in. Whether you're watching on GoToWebinar or you're seeing us on YouTube, either live or on catch-up, if you give us a like, that would be really appreciated. But either way, it's great that you're here. Feel free to ask questions at any stage. So let's have a chat about markets first, okay? Because I seem to have omitted to put in that slide. So let's just have a quick whiz round about what's happening right now. So I'll start with the S&P 500, and you can see from the S&P 500 that we've not been in a very happy place over the last couple of days. There's a few reasons for this, but most of them originate in the White House. If we're entirely honest, there doesn't seem to be a weekend goes by without there being some sort of drama. The latest drama is the sitting president decided to release some texts that it sent relating to the Greenland thing, which is sort of ramped up at the back end of last week when he suggested that 10% was going to be imposed upon any country who didn't support the US taking over Greenland. So tariffs were aimed at 8 countries, 10% potentially moving up to 25 from June the 1st. Then he texted the Norwegian Prime Minister and suggested that that he should have won the Nobel Peace Prize, and they should have done something about it to make it happen because it stopped 8 wars, which of course was nonsense. And because of that, because he hasn't won the Peace Prize, then then perhaps he's not going to think so much about peace. He's going to think about the US. That was published on Truth Social, so it's not me making things up, or he posted that. Anyway, since then, there's other text messages to other, primarily European leaders being published. There's a global financial economic summit going on in Davos, which Greenland has been on the as a major topic. But the rhetoric's not going away. The narrative's increasing and getting more and more stretched in terms of who is poking, which bears is poking, etc., etc. Anyway, so essentially the tariff stuff we saw Treasury sell off, we saw the US dollar sell off, we saw equities sell off. And of course, gold has gone as a flight to safety. But you can see the impact on the European markets here with the DAX down, the FTSE down, the CAC down again. They were obviously down yesterday. The US market was closed on Monday because of Juneteenth Day, so we didn't see the impact until the following day. But you can see there on the US, we saw an over 800 point drop, 1.76% on the Dow, 2% on the S&P 500, and 2.4% on the NASDAQ, which is the worst day for the last 3 months. Right, so that's to play with. Then we've got US earnings, and they ramp up again. At this stage, there's only a handful report, less than 10%. But we see that the ADP weekly employment change is a relatively new figure on Forex Factory. You can see that was worse than expected. You can see GB CPI has moved up. That's not good news for the UK economy. There's those World Economic Forum meetings going on where everybody's invited, but nobody wants to talk to the US delegation. But Trump is due to speak at the World Economic Forum. It'd be interesting to hear what he says. I will be watching markets around that time if you are awake. Unfortunately, most of you are not going to be. This is Melbourne time. I've got this set on, so it's at midnight. Midnight. Not so bad in Perth. 9:30, I might have a little tune in. But of course, this time of year, there's 3 hours difference between Perth and the East Coast. Which means there's 13 hours difference between when things happen in the US and when you get to hear about them. Outside of the US and all its dramas, there is some final GDP number, but the final GDP is least impactful. And then, just to close the week, in case that wasn't enough, we've got some PMI numbers coming out. But probably the story of the week, what's it called? Just to keep an eye on. We've got weekly employment data coming out, but we've got the PMI data coming out from all over the place, actually. Anyway, that's where we're at with everything. Just want to double check. Yeah, there's the PMI data coming out. Consumer sentiment, consumer inflation data as well, out of the US on Thursday. We've also on Thursday, we've also got the PCE data, I think. Yeah. Which of course is the Fed's favorite inflation measure, so that PCE price index will be really important. That comes out at the same time as the weekly jobs, actually comes out a bit later. Comes out after the GDP number and the weekly jobs, which come out before market open, and then the PCE data comes out after market open. So lots of data going on. Earnings are going to be really important, and then obviously the geopolitics. Go and read whatever you can find from what's happening. Hello, Neil. How are you? Right. Okay. So really quite a tough set of circumstances for markets to negotiate. How well are they negotiating? Well, there's the US 500. We've already done that. You can see the US dollar daily. You can see that drop over the last couple of days because obviously the US dollar futures would have traded even if the. Let me just check the dates on these just to make sure. We've got 19th. We've got 20th. We've got 21st. So yeah, the US dollar index traded on Monday. So those Monday, Tuesday, sort of today it's sort of mellowed a little bit, but of course, what's happened to there's silver and gold continues to fly. There's record highs on gold, just really shot up over the last few days. We did have a little pause around this sort of around this 4,600 level for 3 or 4 days, but this week has been really quite impressive, and we are moving with velocity towards 5,000. Outside of that, copper's very choppy, doesn't like. We've still just about made a higher low, but it is looking as though it's going to be range bound, so copper's pulled back. Oil is fairly static this week. So far, Bitcoin is selling off as people cash up. This may come down and test this key level at around about 85,250. That would represent, if we put it on a weekly chart, a low not seen since. So that was the low we hit back there in November. If we start to test that, then the next level is where we were February last year. So lots of selling off in just about everything that's risk on, apart from, of course, gold. Into the FX market, you can see the US yen is bimbling within a range on the daily chart. Put on the 4-hour chart, you'll see that in a little more detail. But we are at the bottom of a range, or not far from the bottom of a range, around about 157.70 is a level to keep an eye on to the downside. And I would say the highs that we saw earlier in the session, earlier in the day, sorry, at around about this 158 is a level to the upside to keep an eye on. A nice range if it does breach, but it's sort of come down from there fairly rapidly. If we look at the Euro USD, this has been in a trading range really since the middle part of the year. You can see the early part of last year was positive. We've been in a range since then. We are pushing towards the top of this range. The level to watch in the medium term is 118.50. In terms of where that is, where we are right now, at this stage, it looks as though it might tip over and go back towards the bottom of the range. We haven't moved very much at all today. GB pound Aussie is probably my FX pick of the day. This is the key level at around about 2. Nice psychological number that was breached. Tested last week, breached again early part of this week, and we're getting a continuation through today. There we go. That was the chart of interest. And you can see this is now lows again, not seen for almost 12 months. So strength in the Aussie. If we look maybe at the Aussie USD, it's about 0.3%. Again, an important technical move on this. So we breached this level here at 67.44, and we look as though we're heading up for a test on the hourly chart of that high we hit back here on the 7th of January. So that level at 67.60 is the one to watch right now, which isn't that far away from where we're trading. You can just see long-term context in this. So these are, again, highs not hit for a long time, back to August 2024 when it was last at these levels. So I actually prefer, right now, I actually like the GB pound Aussie, but the Aussie US, Aussie's just a bit stronger. The RBA not likely to cut rates in the foreseeable. The more likely move to the upside, according to the RBA track. Let's just see actually what the latest figures is on this. Yeah. So about 25% chance that they'll raise rates, about 75% chance that they'll pause when they meet. 3rd of Feb? Yep, 3rd of Feb. Big earnings across the board from the tech sector. Netflix is always the first one to report. That is due this week. We've got a few of the Dow components reporting as well, so just watch how those come in. We'll do a deeper dive possibly on earnings when we next week's session, maybe Monday's lunchtime session. So that's where we're at. Just a quick look at stocks. I'm not really that enthused about anything in the US at this stage. And in fact, Australian stocks aren't filling me full of happy joy feelings. I think just the markets are just sort of saying, no, we need to pull back from this. So just look like any, put it on the ASX account. That's all. Just give it a second. Holiday going really well. Uranium stocks, we talked about these on Monday's session. Let's just put a Palladium chart on here. Daily, let's do that. Let's do standard template. There we go. So you see Paladin, boom. My guess is Deep Yellow is probably going up as well, LYC. So all of these rare earths, precious metals, uranium, all doing really well of late. This move for LYC is technically important. You can see there was the previous level of interest at around about 1558. We talked about this. We said keep an eye on it on Monday for a breach. It breached today. Interest in the last 4 days, it's tried to breach and has just made its way back down to that key level. That's what that is called, resistance. Potential move up in the short term. That's possibly a pause point there. If it breaches there, then we're good to go. Deep Yellow. Let's see Deep Yellow. Look at again another stock that we referenced Monday. Up to 242 is the potential next price target on that. And then lithium stocks going really well. His PLS this is going to be my chart of the day for today, just because the upside on this looks interesting, potentially from a technical point of view. If you put it on the weekly chart, the next port of call is probably around about this 540 level medium term. In the short term, we need to see it breach, but it has breached that level. We need to see it follow through on that. But that's looking really interesting. There we go. Anyway, that's a quick whiz around the markets. So let's get back to what a trading edge is. So traditionally, a trading edge has been sort of described as having some sort of advantage over other market participants. So you're doing something better, quicker, stronger than someone else. That's it. That's really what it is. It's often attributed to a system, but it's really so much more than this. If we look at what traders do and what traders don't do, if you have a trading plan, if you have a plan, you trade it and evaluate it, that gives you an advantage over more than 80% of traders who don't have a comprehensive plan, don't trade it, and don't review it. But you can even do better than that. So that's your start point in terms of where you could go with it. So by definition, an edge could be described as a consistent testable advantage that improves your odds over time of sustainability. So it's doing the right things consistently that we've talked about again and again and again, and make sure that you evaluate things properly, make sure that you manage risk well as manage, and that's both profit risk and capital risk. And of course, a great plan helps that, but it's not a right written in stone, never to be looked at again. It's got to be constantly evaluated. Evaluated for how it performs in different market regimes, evaluated how it performs in different sessions, maybe even different time frames, different directions if you're trading long and short. But really what we're doing when we're looking at how do we develop our edge, once we've got those critical things in place, it really is a combination of idea generation, timing, risk, and execution, not just all about entries, which is what we focus on. Quite often, you'll hear people talking about a trading edge in light of what their entry criteria are. And of course, we know if you can adopt the Pareto principle, if you really want, if you talk to most experienced traders, their major wins and losses have been because of how they manage trades once they're in them, not because they entered at a particularly great time. If you don't have an edge, you're relying on force, some other supernatural power, a bit of luck, not necessarily skill, or the knowledge that you have, and results will just be random or plain ordinary for most people who trade. Now, the statistics bear that out. And you don't have to have the system of systems. If you have a system that wins 48% of the time, but uses a 2.5 to 1 risk reward to risk, that will easily produce long-term profits. So you don't have to shoot to the moon, and that's getting greedy and greedier is obviously one of the psychological battles that traders have to deal with. Seen in things like fear of missing out, or itchy trigger fingers on entry, or any of that sort of stuff that really you need to work on psychologically. So here's some secrets. Secret number one. They're not secrets if you've 10 my sessions before, by the way. An edge is built, not found. There is no magic system. There's no silver bullet. There's no edge. Comes from testing, refining, aligning with your strengths, and to emphasize, it's about your interaction with the market at your time, in your way. Okay, just because you'll often find, I've seen this time and time again, somebody will put up this system will make you X $100,000 in no time. Or I've made $1 million doing this over the last 12 months. Okay, you'll see that time and time again. You'll see people advertise this concept in emails, on YouTube videos, on whatever you want to watch or see. And of course, that sparks interest. Of course it does. But more often than not, even if they're telling the truth and have evidence to back up some of the claims that they're making, the reality is that's their system trading their way at their time, with their capital, with their lot size, not yours. So, irrespective of whether you find the system that looks great and you looks great because somebody's told you, and then you put it into practice and it still looks great, then you've still got to work on this. Magic 8-ball trading, yes, Wayne. But for some people, that would be as good as, particularly with entries. So what you've got to do is you've got to create and implement strategies that fit your routine, your tools, your trading purpose, your emotional style, and of course, your financial situation and personal trading objectives. Copying others may give you their trades, but not their conviction or context. And interestingly, as I've already said, rarely their results either. So, it might be that you're a trader working full time. And so what you do, because of your ability to access the market, is you might build a 4-hourly chart trend model, to match your schedule and avoid intraday noise. Okay, secret 2, probabilities are only as good as your data. So we're going to find out. When we talk about data on which you make decisions, this could be test data or live data. So live data is which you record and still journal or download, and you can download from external sources as well. If the data is no good, then it's not going to give you good results. It's going to create false confidence, fragile strategies, and the need for assumptions and guesswork. And then you throw in some confirmation bias, which is seeing what you want to see and ignoring the things you don't. It becomes a recipe for average at best, and possibly even some damage. One of the things we often talk about is, particularly when we're looking at sort of EAs, etc., is you need a critical mass of trades to make any decision on this. And of course, the retort to that is often, well, how many is enough trades? Well, if you think about it this way, 10 trades is obviously not enough to make any long-term decision on. It's maybe indicative that it's worth something's worth, if that produces good results, worth some more exploration. That's about it. But then say if we did 80 trades, okay, and 40 of these were long and 40 of these were short, and you've already halved your trades. Let's say of those long trades, then 20 of those were on strategy A and 20 of those are on strategy B. Now you've halved again. So now you're down to 20 trades. Let's say that you sort of were trading 2 timeframes on that. You were trading a 30-minute and an hourly chart. Then you're down to 10 trades. So you're back down to that 10 trades. Is it enough to make a decision on? No, it's indicative. And it's one of the reasons why we say get a critical mass of trades, specify what that is, and specify what metrics will enable you to A, continue, B, put it in the bin. We can do all sorts of works on probabilities in terms of what might happen next as we move from candle to candle, and we've had a go at this, and certainly some of you have already seen this probability indicator that we developed. I developed, should we say, because it's not in Go Markets development. Let's just find it. So what this aims to do is saying what is the probability of an uptrend, sideways move, or downtrend in the next 3 to 6 bars. So 3, 5, and 10 bars. So it can give us a probability measure. Okay, it's a forecast of, I'm going to change the word of that. It's really just an indication or an indicative forecast, and what it's doing, it's based on 162 different points. No, 162 different points to create that calculation. Okay, so not surprisingly, at this stage, it looks sort of evenish. Why? Because it's not breached that. It works on the last bar, so it's not taken into account the current bar. Actually, this will be current. If we stuck this on a, what's the yen? You can see there that the chance of an uptrend or a chance of a downtrend is sort of less than 40%. In the next 3 bars, the next 6 bars, it's sort of 50-50, and then just simply because of the way it does the calculation. We're currently testing that. For those of you who are doing this and got access to this, we're looking at it as a potential exit, not a potential entry criteria. And we're looking at how robust it is by putting it to an existing EA and then doing some testing on it. So, hi David, by the way. So that's one type of probability, but we're talking about a probability that says I should move forward on this. So you need to define those key metrics. We've talked about those a few times as well. Probably the most important variable to take into account is what the underlying market is doing when you're trading. We've talked about this multiple times. There's a market regime indicator, which some people would use as filter, some of the EAs do. But the underlying market conditions, if we looked at the S&P 500 here, I'm getting over this. If we look at this, then this is now downtrend. It's flipped over. It's flipped over the last couple of days. Now, how prolonged this downtrend is, well, because why is it in downtrend? Okay, so yes, the 200 MA is in an uptrend direction, very strongly uptrend. But if we look at the basic principles of uptrend and downtrend, is an uptrend is one whereby you've got higher highs and higher lows. So if we look at the higher lows on this, if we take that as the base, there's the next higher low, there's the next higher low, there's the breach. Okay. So we need to see how and when this retraces, and then on we go again. But of course, we'll be keeping an eye on these levels on the way down. That's how we work out uptrend, downtrend, not just the 200 MA. So in the short term, this has moved at best into a sideways channel, but at this stage, the fact that it's breached that level there is technically important. So that's what I mean by market regime. So if you were to trade the US 500 CFD long, you're battling against the main trend. And then, so when you're doing your analysis, then you can start to make judgments on that. But only if you record what the underlying market's doing. And you can even put it into your plan. I won't trade if the longer time frame is not in the same sort of trend as the shorter time frame. At this stage, the shorter time frame is not looking particularly flash either, but it has recovered a little bit off the lows, but we're sort of mid-range even on the short time frame. So we wouldn't be considering long based on that chart. if we're doing if our daily chart was our longer time frame of choice. Now we talked 3 or 4 weeks ago, I think, on using multiple time frames to help make decisions. Interestingly, should we look at that for exit as well? So we could have a system backtesting on trending year spells in a mean reverted market. Generally speaking, mean reversion strategies don't tend to work particularly well in high trending markets, and vice versa. So the specific systems that you can match to specific market regimes generally, and then there's the nuances of whatever time frame you're trading compared to the current multiple time frame picture. Secret 3, edge dies without execution discipline. You can have the best plan in the world on testing, it can produce you an amazing result, but unless you actually trade it as it should be traded, then you're losing your edge, because the edge you created, the expectations are created on actually trading that system. And so great strategies can fail when trades are skipped, rushed, mismanaged. Now that doesn't mean there aren't times where you shouldn't intervene, but it should be documented, and we've obviously put something in place for the hybrid course. Interesting, there's a hybrid. If you want to know what hybrid trading session is, hybrid trading is all about, drop me an email. I'm running a webinar tomorrow night on that. I know most of you have heard, also a lot of you have heard about that. Let me give you, I don't know when you've got one ready that I prepared earlier, but we'll have a look. I think I have. Yep. So this can be used whether you're discretionary or an EA trader. It essentially gives you a choice to close down some position. I'm just going to switch accounts and see if there's more trades open on another account. It'd be interesting to see if they are. I don't know. EAs are pretty quiet today. They obviously don't like markets, or they've obviously closed them out. See that. Nope, just a gold position open on that. Okay, you're still there, some people. Let me know if you can hear me, see me, all that sort of jazz. Abdul, yes, in the question box. Apologies for the delay. No sound as yet. Mouse movement, yeah, okay. Can you hear me now? Just do this. 2. Okay. Right. I'm assuming that's good. Right. Okay. So yeah, generator died. Blown up all sorts of stuff. So I'm using my daughter's phone. Mine's also run out of charge. Anyway, let's get back here onto the mission. We'll see what we can do. Thank you for being patient, hanging around. Okay, emotional interference with your system. Let's see if I can pick this up again. Like fear or revenge kills performance even with good setups. It's so often, as I've already referenced, about exits rather than your entry. That's not saying that entry is important. What it's saying is that entry does have an influence, but it's what you do subsequently that tends to have the most in terms of what profit or loss you sustain on not only every single trade, but in a succession of trades. Consistency and execution, both at the front and back end, is what brings your edge to life. That's really it. Yes, I don't know how much battery she's got left, but we'll see. So an example would be that you, after 2 small losses, you start to hesitate on your third trade, which turns out to be a textbook winner. So consistency and an acceptance that some trades are going against you are both critical components. Secret 4 is psychological biases sabotage the best edges. We've done sessions before on cognitive biases, without a doubt. Things like loss aversion, fear of missing out, overconfidence. We've mentioned confirmation bias already. Some cost, where you sort of say, right, I'm not getting out until it's returned to its former glory. Minimalization bias, so I make decisions on minimal information. It's one of the reasons why I created a dashboard. All of these distort decision making right at the point at which you're about to press the button. So the key message that I'm trying to get over here is that systems are vitally important, and having an evidence-based system that demonstrates over time that it can be successful, but is something that you constantly monitor and evaluate, is of extraordinary importance. Most edge erosion will happen in the space between your ears. That's the reality. We all see the same markets. We all look for good. We all look for good outcomes, but really the 3 things in between that are market awareness, system awareness or system development, and essentially good decision making and follow through. So being honest with yourself, looking in that trading mirror and saying, what have I done well today? What have I not done so well today? And if you've not done so well today, or if you've had a few losses, it's not failure, it's feedback. It's saying, right, I need to work harder on this particular part of my trading. None of us come into this perfect. We all carry some baggage coming into being traders. And it's not easy. It's the easiest, it's the hardest way to make easy money is something that one of my very, very early mentors told me. So just to give an example, a trader breaks plan after seeing a headline written on CNBC or some something on YouTube or whatever, reads the headline, exits early, and watches the price hit target minutes later. It's one of the reasons why we didn't get to talk about that we've done this. We've done this sort of this exit log where you override your plan or override what your EA should be doing. You put in the reason and a comment there, and what you can do subsequently is you can. That's actually looking really good. So that's an EA managed trade. So let's say you wanted to get out of that because you had too many positions in oil. So you could put too many commodities. I'm not going to exit this because I don't want to. Then once you've got that, you can log it and it'll go into a CSV file, which you can then do some analysis on. That's one I wanted to show you before. So by doing that, by having some of these systems in place, by having some checklists, some pre-trade checklists, by having a solid trading plan that's completely specific and unambiguous, then what you're doing is you're actually giving yourself the best chance to execute as you should be, but also record variances in that so you can do some analysis on that later to see whether that decision was a good one or not so good. If it was a good one, then theoretically it should be integrated within your plan as a standard way of behaving. Not using ad hoc stuff. Secret 5 is risk is the edge multiplier. Now, what do I mean by that? Is once you have a system that is demonstrating well or demonstrating the results over time with outcomes, then obviously we've talked before, we've had sessions on scaling and scaling systems, but also we talk lots about reducing as well, not only in terms of just accumulating, but reducing within a trade to possibly bank some profit. Also, maybe as you're starting a new strategy, as you're starting a new time frame, a new instrument that you've not traded before, new asset class you've not traded before. So you might not trade copper before. You're going into trade copper, then you're not familiar about how it's priced or how market moves. So you start at minimum volume, make sure it's okay. Make sure your system works for copper. It might work very well on the Nasdaq or the Aussie yen, but does it work well for copper? Well, you don't know until you try in a live environment. So you can do back tests if you've got the capabilities to do that, but if you haven't, then you start to trade it on live volume, not the same volume as you're trading everything else. Then if you get over enthusiastic because you have a couple of good trades and you start to scale hard, then obviously, yeah, if the next couple of trades work out well, that's all well and good, but it could be that those next trades are shocking and you see the capital diminishing significantly. Risk too much, and that variance ruins you. If you risk too little, then your gains are potentially meaningless. They're not going to make a difference. They're not going to fulfill your trading objectives, whatever that might be. I've talked again on other sessions about having a purpose for trading. That's important. But if you're not scaling, moving towards that purpose based on evidence, based on systems which are solid and continuous monitoring, then it's not going to make a difference. You're going to bimble around $100 up, $50 down, $30 up, $20 down, $60 up, $120 down. And you're just going to see that time and time and time again. It's not going to actually make a difference to your will. So sizing should match both your system stats and your psychological comfort zone. And sometimes scaling is quite scary because all of a sudden you're dealing with big numbers. So that, again, there's all sorts of tactics we can put in place to manage that. Things like having mirror accounts on a demo, which mirrors the exact trades you take, but you scale them up 2, 3, 4, 5 times, just so you get. I sound like Trump then, didn't I? Sorry, he often does that. The price have dropped by 500%, 600%, 1,000%, 15,000%. Anyway, yeah, it was getting a bit like that, wasn't it? But what we need to do is make sure that any scaling we do is based on strict criteria only after a critical mass of trades. And I talked to the EA group that I run about potentially culling EAs, about potentially sizing back. What would be the criteria? What would be the key metrics that would say I need to take some risk off while I just see what's going on here in a little more detail? If you risk 10% of trade, 10% of trade after just a few winners, there's every chance you're going to blow your account up. Or you don't take account of equity drawdown and just look at balance drawdown. That's another good way of blowing your account up. There's a very, very strong argument also, and we've talked about this before, a very, very strong argument for looking at variable sizing positions based on strength of signal, underlying market conditions, current exposure, etc., which again is something that we've referenced in early times. So let's sort of bring it all together. So what with the distraction? So we're giving you 5 secrets in terms of what Edge is all about, in terms of it's not just about system, it's about you, it's about what systems you have in place, not only not only physically articulated within a trading plan, but also those systems to manage your trading world, in terms of your evaluation systems, in terms of your systems for your daily trading agenda, which sets you up right, in terms of having the right information at hand, in terms of recording what you're doing while you're doing it, in terms of making sure that you have appropriate trade sizes and based on current key metrics before you do things like scaling. So, but by doing the right things and by doing the right things consistently, you are automatically trading an edge, because most traders won't still do that. Win some, loss more. Yeah, absolutely. You've seen the ads. So work hard. Well, as I've talked through, and thank you again for those of you who've been hanging on there despite the despite the power outage and generator blow up, and now having to manage a grumpy daughter whose battery on her phone is diminishing quickly. Thank you for being with me here. I hope it's been useful. So what I want you to do is go away and think about this. What is 3 things you could do? Write them down. If you think it, ink it, sort of thing. It's more likely that you're going to do something about it if you write them down. So think about 3 things that you could do today. 3 things that you could do over the next month. You can write them down today that may improve your edge only a little bit. It doesn't have to be by much. Think of it as 1%, 2% at a time. It won't be long before that compounding is creating a major difference potentially. The choice is yours, of course. I can't make you do stuff. I can suggest these are things you can have a look at. You've grabbed some today. The Spartle, it's a little while since I've looked at that. But make the choice, because you do have one, of those 3 things. Which should you be working on, and are you going to work on them? Because there is a choice to or not to. But if you don't, then of course the results are going to be no different, no better than you get today. Score yourself on a scale of 1 to 10. How big an edge do you think you have based? I'll make it 100 if you want. Where would you like it to be in the next 6 months? Make it happen. If you if you've been part of the Trader IQ team for any length of time, you'll have that competency checklist, which I've since redone. But use that. That's a way of going through all the things you should know, you should be doing, scoring yourself where you are now, and then saying, right, what are the next things I want to work on? And then you can actually quantify to some degree some progress. That always helps in terms of ongoing motivation. So do some things. Write those 3 things down. Scale yourself from where you are now, and do the right things to make it happen. You know, yeah, if there's anything, if there's any resources you need or things you need to know about, then just drop me an email, mike.smith@gomarcus.com. And that being said, thank you very much for being here today. We'll see you hopefully, if we do get power back on, at tomorrow's lunchtime session. Keep an eye on that. I'll have to see what happens to the YouTube video. I might have to edit it and put it back up. But I will thank my daughter too. So yes, I'll have to go and will do. I'll have to go and buy her something nice now. But since I can't cook anyway because there's no power, then maybe that's all good. Anyway, you guys take care of yourself. Enjoy the rest of your Wednesday evening. It's a pleasure and a privilege, as always, to serve. Take care. We'll see you soon. Bye-bye.